This episode is sponsored by our friends at Ycharts, the ultimate platform you need in your toolkit for turning your financial insights into captivating client conversations. With Ycharts, each output is a powerful visual that brings your analysis to life and intuitively explains the why behind your strategy. Don't get bogged down in the nitty-gritty of data and report creation. With features like PDF reports, proposal generations, fundamental charts, and free content resources, Ycharts gives you the visual edge you need to make a lasting impression and seal the deal. I do a lot of posts on Yet Another Value blog, and if you'll notice in almost every post, I have charts that come straight from Ycharts. And the reason is simple. The charts look great. And, I don't want to spend my time creating charts and creating graphs and everything. I want to spend my time writing or researching or reading. And with Ycharts, I can get great looking charts and I can get them really quickly and exactly how I want them. So if you are interested in Ycharts, click the link in the show notes to start your free Ycharts trial and level up your game with Ycharts. Check the link in the show notes. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on from Rome Cat, Alex and Jason Quan. Guys, how's it going?
Hi, Andrew. We're doing great. Thank you so much for this podcast.
Hey, well, thank you guys. Thank you guys so much for coming on. I want to get into a bunch of different things, but before we get started, just remind everyone that nothing on this podcast is investing advice. Please consult a financial advisor, do your own work. That's always true, but today we're going to be talking about a Hong Kong listed, obviously international stock. It's on the bigger side for a Hong Kong listed stock, but obviously international stocks carry extra risks, extra tax consequences, all that sort of stuff. So again, not financial advice. Please consult a financial advisor. Alex, Jason, I generally hop straight into the idea in this podcast, but you guys are, as we were talking about before, newer on the podcast or new around. So I just wanted to give you guys a quick opportunity to introduce yourselves, your backgrounds, what you're doing. So maybe Alex, do you want to go first?
Sure, perfect. Thank you so much. And it's really our honor. So we are Alex and Jason. We were classmates from Columbia Business School. We had our MBA over there, value investing. So we're now launching the Rome Capital. And what we're trying to do is, number one is on special situation opportunities. And number two is on the small and mid cap growth company. Mostly in the Europe or US exchanges. So today we're bringing Samsonite to the podcast. It falls in the special situation category.
Perfect. Jason, did you want to add anything there or we could do any of your background?
I very feel that Alex and I, we graduated from Columbia and we studied value investing. We had the same classmates. So he's the founder and co-founder of Rome Capital. So it's a mainly family capital business. So that's it.
Perfect. Well, let's dive into the idea that we were kind of chatting about and looking at. So the idea is Samsonite. The ticker is 1910. Again, that's traded in Hong Kong, so everybody should just keep that in mind. This has been a pretty popular kind of dual special situation value investment among value investors, special situation investors, at least that I track in. So really excited to do it on the podcast. Alex, I guess I'll just toss it over to you though. What is Samsonite and why are so many investors interested in it right now?
Okay, great. So a couple of points. So number one, Samsonite is a global luggage case leader. So it's a niche industry and not many famous brands. So Samsonite has three major brands. That is Samsonite for the upper end, Tumi for the premium brand, and also American Tourister for the mid end. So it is a leader. And number two is that, during COVID, the industry had a huge problem because people suddenly stopped traveling. But during that time, Samsonite, the management has really turned around the business. They closed 300 stores and have a much higher sales per store and much higher margin than pre-COVID. So that turnaround was pretty successful. And number three is that the valuation of Samsonite is dirt cheap. So on a forward basis, the PE ratio is around 9, and EV/EBITDA is 6.5. That is because it is listed in Hong Kong, and that exchange is really given up by the investor community. But what is good is that the company is making the moves. They are going to do a secondary listing either in US or in Europe, probably in the first half 2025, so in a year's time. And we found that the peers, mainly consumer brands in the US, are most of them are trading at 20 times. So in that sense, we think there could be an upside as big as 100%.
Jason, did you want to add anything to that?
Nope.
Great.
At high level, that's it.
So I want to dive into a bunch of different things, but let me just start, and either of you two can ask it. I think you guys are my guinea pigs. I'm going to try and make this my first question on the podcast going forward, assuming I can remember. But look, the world is a competitive place, right? I guess my question is, like, what are you seeing that the average market participant is missing here? Like, what do you kind of think your edge that's going to result in alpha from this investment?
Yeah, let me get to it first, and Jason, you may add on if you want to. So, in our opinion, the Hong Kong market is, it's deserted. But number one, since COVID and the trade war between China and US, the Ukraine war, the geopolitical tension, a lot of global LPs, they are very cautious about Chinese related assets. So they're drawing their money back from Hong Kong as well as mainland China. And therefore, as a Hong Kong listed international company, the Samsonite has has had the collateral damage. So, before COVID, Samsonite's PE at most of the time was over 20 times. But now even the business is in a better shape. It still got a much lower valuation. And number two is that, because Hong Kong is an offshore market, so both the most of the listed company as well as the investors are offshore investors. So, so it is quite clear. So whenever the market, has a crisis or something, they will draw the money from Hong Kong to their home countries first. So, I've been investing in Hong Kong for 10 years. I never seen a Chinese analyst or PM talking about Samsonite or other Hong Kong listed international company. So it's really, it never got the attentions from the mainstream investors in Hong Kong. So that is why we think going to a European or a US exchange, you will get more attention. And also the management team, they are based in the US, they are Americans. They will have better communication with the US investors. So we believe those would help. And Jason, would you like to add anything?
Yeah, just one quick point. Speaking of liquidity, the liquidity issue in Hong Kong Stock Exchange is almost worse among the world, almost like 1/10 compared to the US. So if you have liquidity issues, probably your valuation won't go too high. Yep.
So it sounds you guys are making an exchange argument, right? And I've seen this before. It's funny, like I've joked, and sometimes people don't get the sarcasm when I say it. Like I look at a lot of London listed stocks, and like the London market is basically a developing market at this point, right? Like companies are left for dead, all that. I certainly hear you on that point, but I guess this will actually take me nicely to my next point. Like, Alex, when you were going through the overview and you did a nice job there, you were talking, you said, hey, look, the company is trading 6.5 times EBITDA, like 10 times PE. And look, those are cheap multiples. You know, the S&P 500, I think you mentioned you're right, it probably trades for 20 times price to earnings now. I don't think anybody's going to compare Samsonite to Google or Meta or something, but you know, those are cheap multiples. But when I hear Samsonite, I say, oh yeah, that's the people who make the expensive travel luggage. When I hear travel luggage, I kind of say, oh, that seems like a pretty low margin, low return business. Like that does seem like the type of thing that would trade for 10 times price earnings. Like ignoring the COVID recovery, like this is a business that probably grows at GDP or maybe sub GDP. It doesn't seem like it'd be hard to start making baggage. So I guess my question would be like, why is 10 times price to earnings, 6.5 times EVT? But like, why is that a cheap multiple?
Yeah, Jason, maybe you would like to talk about the moat of Samsonite, and yeah, we can argue that it is a not bad business and deserve a decent multiple.
Sure, I will agree that first we want to set the tones. It's not like a A or A plus business, right? But after all, we like it. We think it's maybe a B or B plus business, meaning that it has certain barrier to entry and competitive advantages with a foreseeable, very long growth runway. 3 points we want to talk about it. Firstly, is the brand awareness, right? If you interview a consumer, Samsonite or Tumi or American Tourista will pop up very quickly on their mind. And Samsonite have a very strong portfolio of them. And that portfolio actually gives them some pricing power. For example, in the past 4 or 5 years, their ASP has been increasing about 5% CAGR. It's not perfect like LVMH, right? But that demonstrates that their brand has some pricing premium.
Let me just dive into that real quick, Jason. I hear you.
Sure.
They've increased 5%. And like, as soon as you guys said Samsonite and Tumi, I don't pay attention to that, but I kind of knew what they were. And like Samsonite in my head, it's Samsonite, right? The one with the silver, the square silver luggage that everyone has in the airport, right? That's kind of hard. That's the Samsonite brand. Am I remembering that correctly?
That sounds like Remova, right? Is that Remova?
Which one?
The silver one with aluminum?
I
the
think
silver one. That sounds Remova.
Maybe there are multiple ones because Samsonite, if I remember, also had the silver one I'm thinking of in their presentation. But let me just, either way, like you say, hey, it pops into consumers' mind, and I hear you, but and maybe I'm unique in this, but if I was looking for luggage, like what I would do is I would go to Amazon and I would type in luggage, and I would probably buy like the first one that was kind of the cheapest. And Samsonite, I believe, has 15% of the market, and their returns on invested capital are like actually above their cost of capital. So maybe I'm being too harsh on this, but you know, I'm kind of surprised. Like I'm looking at Amazon as we speak. There is an Amazon Basics, like nice hard side carry-on luggage, $70 you can buy it, versus Samsonite does pop up pretty early in there, but they've got like $300 plus luggage. I think those are 2 pieces, but you know, I'm a little surprised that they have any pricing power, that they can get above market returns on invested capital. Like, why is that? Because luggage, you're going to buy once every 10 years. It's not a habitual purchase. Again, you can get it on Amazon. Like, I don't think people are searching Samsonite specifically. As you said, it's not LVMH. No. So why do they have pricing power? Like, why is this a B business and not, in my mind, what I'm painting it as a C- business?
Yeah. The second point I want to talk about is about like scaling. For example, if you in the Amazon, right, you just type mortgage, you probably come to Swiss Amazon private label, and Samsonite will be there. But mostly Samsonite's pricing, for example, a carry-on luggage about $125, $150. They have some premium ones, like more than $300, or even someone similar pricing to Remova. But most of them is still the similar price, like $100 to $200. But here we want to talk about the scaling. The reason is that, come on, it's just doable, right? It looks like a commodity business. But because of their scaling, their sourcing has some advantages. Their procurement cost is about, due to our research, about 15 to 20% at the most lower than some smaller peers, so that they will have a better EBITDA margin because they have a lower cost of goods sold. And also about advertising, right? For example, VIP is a local brand in India, very competitive, I remember. but their total revenue is $700 million per year. However, Samsonite have about $4 billion, meaning that they will have $200 million advertising budget each year. That helps. And the very minor point about the scaling is that, for example, if you buy Amazon Basic, for example, some private brand in the States, right? And you're traveling to Europe, you're traveling to China, and it's broke. What you're going to do? Probably buy a new one. But in Samsonite, you have a warrant. If you travel to China, you can fix it there. If they couldn't fix it, they will give you a new one.
This episode is sponsored by our friends at Ycharts, the ultimate platform you need in your toolkit for turning your financial insights into captivating client conversations. With Ycharts, each output is a powerful visual that brings your analysis to life and intuitively explains the why behind your strategy. Don't get bogged down in the nitty-gritty of data and report creation. With features like PDF reports, proposal generations, fundamental charts, and free content resources, Ycharts gives you the visual edge you need to make a lasting impression and seal the deal. I do a lot of posts on Yet Another Value blog, and if you'll notice in almost every post, I have charts that come straight from Ycharts. And the reason is simple. The charts look great. And, I don't want to spend my time creating charts and creating graphs and everything. I want to spend my time writing or researching or reading. And with Ycharts, I can get great looking charts and I can get them really quickly and exactly how I want them. So if you are interested in Ycharts, click the link in the show notes to start your free Ycharts trial and level up your game with Ycharts. Check the link in the show notes. I am laughing because I told my wife, I was like, hey, I'm going to be doing a podcast on Samsonite. And she actually wanted me to tell you guys, when we were in Europe, like 2 years ago or something, she had a Samsonite and it broke. Now, we did not know about the warranty and we did not get it fit, but she just wanted you guys to know that she had a Samsonite and it broke on us and she was lugging around, a wheel bag where the wheel wasn't working. So I'm just saying it because you mentioned it. How important, so let me just dive into these things. How important is the warranty, right? Obviously, I mentioned my wife, her luggage broke, but I've never had a piece of luggage break on me before. And kind of to me, you say, oh, if you have your luggage break in China, Europe, wherever, you can get the warranty and have them replace it. In my mind, I would have never thought of that.
It's a minor advantage to my point. My luggage, my Samsonite really screwed up when I was traveling in Japan. I even forgot I got the warrant. But again, when we say brand awareness and scaling, there are multiple factors making certain competitive edges. And also I want to talk about it's a niche market. To our research, it's not only 15% of market share, probably more, like 17, 18, close to 20. If you look at their revenues, meaning that at a global basis, it's a relative niche market. Meaning, for example, if you are a consumer brand conglomerate, do you want to go to this niche market and begin a pricing war? Probably not. You may, but you are less incentivized to do that. So again, the third point I want to say is just it's a niche market.
Go ahead, Alex.
Yeah, Andrew, I hear you that, I have been joking with my investor friends. So Samsonite, this type of brand and products are not for value investors. If I'm going to buy luggage, I'll do the same way as you do. But when we talk to our wives, a Samsonite brand is nice to have. Even for me, it's nice to have if I want to pay for the extra money to have a good brand, good quality, good insurance on the products. So I believe it's better than it's still better than no brand products. Yeah,
look, I completely. I don't disagree with you. I just, in my mind, and this is one of the things we all learn in investing, right? Like the way you view the world is not the way other people view in the world. Like I've never smoked tobacco and I have no interest in that, but a lot of people do. And that doesn't mean I can't those tobacco stocks have great moats now, declining moats because all their customers are dying. But, just because you don't see something one way doesn't mean other people don't see another way. I guess I want to go to one other thing Jason said. Jason, you mentioned, I think it was kind of like a 15 up, and of course, Jason dropped as I was going to. Alex, maybe you can take it, or maybe we can grab Jason back if he comes back in. But Jason mentioned a 15 to 20% advantage for Samsonite over their competitors in terms of sourcing. How do they get 15 to 20%? Just curious on that side.
Yeah, so the number we got was from the industry people. So different people say that. So we believe in that, and it's a range between 10 to 20. But I think 15 is a credible number. That's because of their scale. And another proof of that is because during COVID. A lot of the businesses had a supply chain problem, and because Samsonite has the biggest scale in the industry, so their inventory, their supply chain still worked well. So that gave them a big advantage. So I don't think it's unique in this industry. It happens in a lot of other industries too.
Perfect. Jason, did you want to add anything to that?
Nope, thanks.
Okay, perfect. Let's just move on. So I think a big thing people are looking at here is, you guys are looking at it. I know my other friends are looking at it. We talked about, they're on the Hong Kong exchange. They trade for a 10 times PE. They're going to do a dual listing, right? And they said this in the March thing. They reiterated it on their May. I just finished reading their May Q1 earnings call. They said we're looking at dual listing. I guess I have two questions on dual listing. Number one, in May, they said, hey, it's a lot of time. We've hired banks. It's going to be a lot of work. It takes a lot of time. This is not a near-term thing. Why is that not a near-term thing? I mean, especially they're dual listing, not relisting. So it seems like it should be pretty darn fast if they want to dual list somewhere. What's taking so long? Why does it take so much work?
Okay, number one, that is quite interesting. So number one, even though on the March announcement, it said dual listing, but actually in our most recent communication with the company IR, they have changed it to secondary listing instead of dual listing, because for dual listing, the stocks in different exchanges are not fungible, but we have confirmed with the company being fungible is one of their priority behind this move. So probably it would be a secondary listing. And number two is on the process or schedule of the secondary listing. That is one thing we are not particularly happy about it. We really wish the company could move more quickly on it. And we even talked to the investment bankers, and they believe if they work really hard on it, it could be completed in 2 quarters. So that's what we're not happy about. And we really wish they could speed it up, or there are some activists could urge them to speed up. But anyway, the company will give a clear schedule or a plan during their first half results in August. And the company IR personally told us that he expected it to be completed in first half of 2025. So
okay.
That's it.
Look, dual listings, relistings, secondary listings are all interesting, right? Like, I think historically, every time someone has come to me and said, hey, XYZ company trades in London or trades in Europe, and they're going to change their listing from Europe to the United States, I would always kind of skeptically say, look, I mean, the company is the company, right? It trades for $10 when it's in Europe. Why should changing your primary venue from Europe to the US make a difference? And I've kind of seen one too many times a company that's done that and seen their stock go up 50% to doubt it. And like in this case, I know people, I've seen people who are like, oh, this company, which is the dominant Spanish grocery store and trades on the Spanish exchange, they should relist to the US to get a better rating. And I'm kind of like, I don't know about this. But here, it is a company that a lot of their earnings are from the US. It's a global business. Like, you can absolutely see it. So I guess I am leading the witness, but do you guys really think simply relisting to the US can re-rate the shares? And I guess I will ask, can you point to like, what multiple do you think kind of peers or this should trade at if it does relist to the US?
Okay, I'll take this one. Maybe Alex could comment. So the first thing is that theoretically, right, from a just pure value perspective, no matter where it's listed, their valuation should be the same. However, in reality, very unfortunately, it's just not, right? Even London companies want to go to US, for example, IWG, right? They may be working on this. But again, what we think is that firstly, in Hong Kong, just nobody taking a look at it. No mutual fund, no hedge fund, no big money from mainland China looking at it. However, in the US, it's a US company, largest market is the US, and it's going to grow at a minimum middle single digit in the foreseeable future, and it has an okay EBITDA margin, right? It's acceptable, and with reasonable dividend payout ratio, about 35 to 40%, and the company just announced the buyback plan, haven't executed on it yet. From our understanding, this should welcome some mutual funds or some even 401k investor to look at it, because the pay dividends is stable business, it's mid-single digit, and it grows faster than US GDP. That's cool. And secondly, about comparables, I want to say it's tricky to find the perfect comparables because their direct competitors are either private company or under conglomerate. However, we can still find some hints. For example, if we look at some discretionary consumer companies with mid to high single digit growth in the long run, for example, Yeti Holdings, right, is for outdoor equipment. They produce like drinkware, cooler, backpack, etc. Their outlook about mid to high single digit. Even with some headwinds right now, they're trading like 19 times PE. Mm-hmm. Another example you may argue with me is a Columbia Sportswear. I know it's a sportswear, it's outdoor, it's durable, right? You can wear the sportswear for 10 years. They even have a recent low single digit decline, but still trading at like 19.5 times PE. And pre-COVID, they have a mid-single digit growth. They're trading like 20 to 25 PE. So that's the reason we're relatively confident that if they go back to the US, given some time, their multiple expansion should catch up to almost like 20 times. Alex, anything else?
Yeah, I would just add on an anecdote. It was from the communication between the company CEO with one of our friends. So the CEO actually complained that they have done a successful turnaround during the COVID, and they held analyst meetings, and actually the major banks, Goldman Sachs, Morgan Stanley, they were all there. But the problem is it is their Hong Kong team, and they listened about it, they wrote about it, but the information, just the message, just cannot transmitted to their U.S. headquarters. So he thinks when they got a listing in U.S. or maybe somewhere else, they would draw more attention from the investment bank analysts as well as the mutual funds. So maybe that will help.
Let me ask you another question. So another pushback I always have on the relisting trade is, look, okay, if they're trading for 10 times price to earnings in Hong Kong and all the peers are trading for 20 times price to earnings, like one way to capture that is to relist and let your stock re-rate. But a better way to capture that would be buy shares as aggressively as you can on the open market while they're trading for 10, and then relist, or then sell to private equity. And we can talk about private equity sales in a second. And it does strike me like Samsonite, again, it's a low growth business that generates a lot of cash, And as that generates a lot of the cash. And as you guys mentioned, and as they mentioned, if you look at their earnings call, they're getting ready to start returning capital to shareholders. And it seems like, correct me if I'm wrong, they're going to do that through a dividend. And I guess I want to ask you guys, why don't they just capture this for themselves? Like, I believe your write-up mentions, hey, between the CEO and the chairman, I think they own combined over $100 million worth of stock. Like, these guys should be very incentivized by the share price. Why don't they just buy back a ton of stock and then keep doing it until the market either gets the hint or, they become the first company to do the famous, what happens when you buy back the last share?
Actually, that is what they are trying to do, though not on a very large scale. So, earlier in June, they announced to buy back 200 million shares. Was it? 200 million shares. And that would account to 5% of the total shares outstanding. And what's the motivation behind it is to use shares they buy back to reissue, then issue it on the secondary listing. So that kind of is what you have suggested. But yeah, we do appreciate it if they can do it on a larger scale. But the fact is, in Hong Kong, in China, there isn't a culture for share buyback. So the companies just prefer to pay dividends over here. And hopefully, if the company could list in the US, the investor community could make some activism to help them make smarter capital allocation decisions. And on the shareholding of the company management team, I think they have enough skins in the game. They benefit if the stock price go up, and they get hurt if the price goes down. But on whether they are going to buy stocks by themselves, I think it's just their personal decision. We cannot comment too much. But
another one I want to say, is that from Andrew, what I'm understanding, right? Maybe someone say, hey, why don't you go private, right? And then you go back home to the US, release. However, privatization is not a super easy process in Hong Kong Stock Exchange, so that it makes things complicated. Well, and we remember the CEO deliberately say they don't consider privatization, so probably secondary listing is the best for them.
This episode is sponsored by our friends at Ycharts, the ultimate platform you need in your toolkit for turning your financial insights into captivating client conversations. With Ycharts, each output is a powerful visual that brings your analysis to life and intuitively explains the why behind your strategy. Don't get bogged down in the nitty-gritty of data and report creation. With features like PDF reports, proposal generations, fundamental charts, and free content resources, Ycharts gives you the visual edge you need to make a lasting impression and seal the deal. I do a lot of posts on Yet Another Value blog, and if you'll notice in almost every post, I have charts that come straight from Ycharts. And the reason is simple. The charts look great. And, I don't want to spend my time creating charts and creating graphs and everything. I want to spend my time writing or researching or reading. And with Ycharts, I can get great looking charts and I can get them really quickly and exactly how I want them. So if you are interested in Ycharts, click the link in the show notes to start your free Ycharts trial and level up your game with Ycharts. Check the link in the show notes. No, it's funny you asked that because that was my next question. Back in, it was either late February or early March, Bloomberg reported that they were, I believe the report was private equity had expressed interest in taking them over, and they were considering strategic options or whatever. And, the stock, I'm just looking at the chart as we speak, the stock goes from 23 to 25 to, it peaks at over 30. And as you and I are talking today, it's kind of in the 20 to 21 range. So I was going to ask you, what happened with the private equity bid? And I think the other thing listeners might be interested to note, in 2007, correct me if I'm wrong, they were taken over, they were owned by, it's a good private equity fund, but I can't remember the name off the top of my head. I think it starts with a C, but CVC, it was CVC. CVC took them out in 2007. So not only has private equity expressed interest in them now, they do have some past history with private equity. I don't know, Jason, you were kind of addressing that. I don't know if you want to finish talking about that specific rumor or private equity going forward possibilities.
Alex, please.
Yes. So, in my opinion, it could be that several private equities have discussed that opportunity internally, but we believe nothing has been, has been offered to the company, because if due per the exchange rules, there should be a suspension on trading, of the stocks, but nothing happened. And then until now, and as a company announced to do the secondary listing, and then people stopped, guessing about the people stop thinking that's a viable option, at least for the moment. So it's a complete rumor in our opinion, but the valuation is really low, and the private equity firm does see value, especially I think at the low price today.
Let's put the dual listing and the private equity story aside. I think we've addressed it pretty nicely, and I think people can see like that is the major catalyst. That's kind of the sexy piece of the story. But I do have one more piece of the business I want to come back to, right? So I was looking at the Q1 results, and this is Q1, but even though Christmas I'm sure is a big season and summer, probably broadly representative of the year, 27% of their sales are retail. So they own their own stores, Samsonite Tumi stores. I'm pretty sure I've seen Samsonite stores in airports before. About 2/3 of the sales are wholesale. So, they sell to Amazon, which sells it, or they sell to Target, which sells Samsonite luggage. I'm not sure where they're selling, or your local travel store. And then 10% is online e-commerce. They call it DTC. So I think that's someone going onto the Samsonite website and buying. And I just want to, the wholesale business is such a big piece of that business. Obviously, like they've got relationships with retailers, all that sort of stuff. But I just wanted to, I hate to use double click, my consulting terms are coming out. I just wanted to click on that for a second, talk about like, look, when I see 2/3 and it's the major luggage person with 15% of luggage share, like it seems like they've got a distribution advantage there. And I just want to talk about like, who are their wholesale partners? How do those relationships look like? Am I right that that's probably one of their competitive advantages? Does all that make sense?
How to say? Yeah, we do believe, as a leading brand, they should have the largest, distribution channel in the industry. So, but based on our communication with the company or with the industry people, nobody emphasized that point, very much. But yeah, that's an interesting point. We can, dig more into it. So Jason, would you like to add on anything?
Nope.
Well, let me ask one more point. Jason earlier was mentioning, this is a thing, right? You own 15% of the industry. You're the largest person. Look, you can put more money into advertising and it will be a lower percentage of your sales than other people. And that creates huge advantages for things where advertising is a driver. The bigger advertising is as a driver of demand, the better, because then you've got a bigger advertising budget. It's lower percentage sales. That creates a very virtuous cycle, which is that how much does advertising really drive demand and consumption here?
So basically your question is asking that is the advertising is a key driver?
Yeah, exactly. Yeah.
So firstly, we think it definitely help, but I think the most important thing is the brand awareness. Basically that their brand already rooted in the conception of the consumers, right? The example I mentioned that we do some quick surveys, right? Just their names or their portfolio company's name just quickly pop up. And right now, if we just Google it, we can easily see somewhere in a travel website, Samsonite advertising just pop up. And we think it also helps. However, we do not have direct ROI data on their advertising. So we have to go with our common sense. It helps, but the brand is, I think, is more important.
No, makes total sense to me. I just, again, it's a tougher market for me. All right, one more, and then we can kind of hit last thoughts and wrap this up. Right now they've got 15%, but when I just Googled travel luggage, and you mentioned Yeti earlier, which is why I'm asking the question, but Yeti pops up as they have Yeti luggage now, which is kind of funny to me, but they've got Yeti luggage. There's Away Travel, which I'm not familiar with, but the luggage looks very much like Samsonite. Now it looks like they're selling at a premium, but I guess my question is, in today's world, I'm always worried about like legacy brand-ish, whether it's Hanes with underwear, or you can name your brand, but I'm always worried about legacy brands. It just seems a lot easier for startup brands to enter any market they want to now, right? They can find manufacturing in Asia. They can drop ship from Asia directly, and they can do like heavy online advertising. So I do just want to ask, like, do you guys worry about whether it's Yeti or, whoever wins the next season of The Bachelorette launching their own, hey, Bachelorette branded travel luggage? Do you guys kind of worry about maybe 2020 to 2022, they're kind of protected from new brands just because nobody wants to launch a travel brand during 2020, 2022. But as we merge, like going forward, they're kind of more prone to competition, if that makes sense.
I'll take this one. Maybe Alice can complement. So basically, not only Yeti Holdings, right, but also VF Corporations is famous for its outdoor shoes, outdoor gear, Timberland, North Face. They also have a certain amount of a meaningful market share. And we see in the past decade, Remova is really growing fast, right? Especially under LVMH. They're growing like 9% CAGR in the past 8 years or so. But however, again, it's not the industry with extremely high barrier to entry. However, to build a brand and portfolio, it may take decades, right? Like 10 years, 20 years. And also, again, as we said, even if we look at Yeti, VF Corporations, right? It's a similar price. The product looks almost identical to Samsonite or to me. It's not their core product portfolio. And given it's a niche market, we do not think they have a strong incentive to go there, huge discount, crazy advertising to market their products. It's possible, but it's not very probable. Alex?
Yes, Andrew. I think that could be one of the major risks of the business, and we do think the biggest threats are from some of the Chinese low-cost manufacturers. Actually, companies like Xiaomi, NetEase, those are internet companies, and they broke into this category. But anyway, it won't be their main focus. They just made it and sell it if they can. And as they are, if you look at the industry structure, I think the no brand name products, it consists a big part of it. So the truth is, a lot of people, there are a big portion of people who just don't care about the brands a lot, but also there are quite some people still cares. So we believe, Samsonite could, sustain its market share for a period of time. Just like the Columbia brands, North Face or Yeti, their products are not difficult to manufacture either. So they live on their brand name, on their marketing as good quality good quality products as well.
I agree with most of what you said. The only thing I would push back on is I do think a North Face, right, where it's something that you put on so you visibly wear, and you probably wear it, maybe I am neglecting my, I used to be a consultant, my consultant brethren who are traveling, to 4 cities every week or something. But most people, when they buy luggage, are probably looking to use it once a quarter, right? 4 times a year or something. So buying something with a 10-year view that you're using once a quarter and you're probably maybe replace it every 10 years. I mean, my parents have, they don't travel a lot, but they have luggage that is 30 years old, right? Versus a North Face jacket, which you're going to use. I might wear my North Face jacket like every day or something, and it's literally on me. So that label means more to kind of my brand identity than the suitcase I'm lugging behind me that I'm instantly going to store in my hotel. So I definitely hear you there, but there is something to, now we're not saying this is a North Face business, right? Most people would probably say North Face is like a B+, A- business. I'm just pulling that out, but something around there, whereas you guys were kind of like, this is a B, B-, but that's the only place I would push back there.
Okay. Yeah, I hear you. Yeah, you can, give some discount on it, if you like. However, our point is that at the end of the day, the secondary listing is at the door. It's gonna happen hopefully soon enough, and we would like to see some re-rate after that. And we don't think we'll hold the company for 5 years or something. So it's still a special situation play.
Perfect.
Yeah, that's
Perfect.
the main point.
Makes total sense. Guys, we have hit we've hit all of my questions for the most part. Just before we wrap this up, is there any place you wish we should have gone through, and any other thing you guys want to discuss? Alex, Jason, either of you?
One thing is that many investors we talk to, they may concern that, right, nowadays, globally, not only in the US, not only in China, right, globally, consumer retail has been under pressure. But we think, even though some headwinds, for example, their Q1 growth has been slowed a little bit, but it could be only temporary. Because you have to travel, right? Even when we look at the IATA data, when we look at the Hilton or Marriott data, the travel industry is still growing, but just slower a little bit. So we think the headwinds should be temporary. Even if the worst case scenario, we look at 2008, right? Great financial crisis. It took them about 12.5 years to turn around, and that's it. So we think this business is relatively resilient, even with some consumer headwinds. Yep.
Yeah, one point I'd like to add is that the global consumer demand headwind is there for everybody, for every consumer brands. And
no, I love that point, because the first thing you mentioned is like, hey, what if there's a recession? It's like, look, this company isn't heavily levered. Yes, if there's a recession, I'm sure their sales will go down. I'm sure everyone's sales will go down. But can we look through that? Like, can we just talk about normalized earnings, normalized valuation? Like, if you're worried about a recession, or you're convinced there's a recession, there's probably better ways to play than buying or passing on Samsonite, right? Like, you can go buy puts on the indexes, or you can find the most consumer sensitive stock that are really levered and short. So I really like how you framed that, Alex.
Yeah. If you buy other consumer names, if the things goes really bad, you get hit on the earnings and hit on the valuation too. But if you buy Samsonite, even though the earnings got a little bit hit, you still get a revaluation on the multiples. So we think it's gonna do better than other peers, and you can hedge it.
Perfect. Well, guys, look, I'm going to include a link to Alex's write-up in the show notes, so people can go read that for the full write-up, and probably it's on Substack, so it's pretty easy to figure out how to communicate with these guys once you've got that link. So, Alex, Jason, look, just thank you so much for coming on. Thank you for the interesting idea, and hey, good luck with the launch of RoamCap, and B, looking forward to having you guys on the future.
Thank you so much.
Thank you, Andrew.
Perfect.
Really appreciate this opportunity. It's good.
Hey, thanks for coming on, guys. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.